Hey everyone! Welcome to this comprehensive guide on one of the most misunderstood concepts in day trading, consolidations. I'm going to break this down for you in plain English, so whether you're a complete beginner or you've been struggling to understand why your trades keep getting stopped out, this video series is for you. Now, here's the thing. Most traders think consolidations are boring. They see price moving sideways and think nothing's happening. But that's exactly what the big money wants you to think. In reality, consolidations are where some of the most sophisticated market manipulation happens. Over the next 16 slides, we're going to dive deep into everything you need to know about consolidations. We'll cover what they really are, why they happen, how to spot them, and most importantly, how to avoid getting trapped in them, like 90% of retail traders do. By the end of this, you'll understand why professional traders call these seek and destroy conditions, and you'll have the knowledge to either avoid them completely or trade them profitably. So, let's get started.
All right, let's start with the basics. What exactly is a consolidation? Think of it like this. Imagine you're watching a tennis match, but instead of the ball flying back and forth quickly, it's just bouncing gently between two players who are standing really close together. That's essentially what price does during a consolidation. Technically speaking, a consolidation is when price gets stuck between a high point and a low point for an extended period. You can draw two horizontal lines, one at the top, one at the bottom, and price just bounces between them like a ping pong ball. Now here's what most people don't understand. This isn't random. This isn't the market taking a break. This is actually one of the most active periods for big institutional traders. While you and I see boring sideways movement, they're quietly building massive positions. The key characteristic of a consolidation is that price lacks clear directional order flow. What does that mean in plain English? It means there's no strong buying pressure pushing it up and no strong selling pressure pushing it down. It's in limbo. You'll see this on your charts as choppy, indecisive candles. Lots of wicks on both sides. Maybe price tries to break higher, fails, comes back down. Tries to break lower, fails, comes back up. This back and forth creates what we call low probability conditions, meaning if you try to trade it, you're probably going to lose money. Remember this golden rule. Consolidations are meant to be avoided, not traded.
Now let's talk about what's really going on behind the scenes during a consolidation. This is where it gets fascinating because there is essentially a psychological war happening between different types of traders. On one side, you have retail traders, most individual traders like you and me. When we see a consolidation, we're thinking things like, "Oh, it's going to break out soon," or "I can make quick profits scalping this range." We're impatient. We want action. We want to trade. On the other side, you have smart money. These are the big institutions, banks, and professional traders who move millions or billions of dollars. They're not impatient at all. In fact, they're the ones creating this consolidation on purpose. Here's how it works. Smart money needs to buy or sell huge positions, but they can't just market buy $100 million worth of a currency pair. That would move the price massively and cost them a fortune. So instead, they do it slowly, over time during these consolidation periods. While retail traders are getting frustrated and making bad trades, smart money is quietly accumulating orders on both sides of the market. They're allowing orders to build up above the high and below the low. Think of it like setting multiple mousetraps. The consolidation creates what we call open float, a bunch of stop losses and breakout orders statting up at predictable levels.
Retail traders put their stops just below the low if they're long or just above the high if they're short. Breakout traders set orders to buy above the high or sell below the low. Smart money knows exactly where all these orders are, and when they're ready to make their move, they'll trigger these levels to use retail traders as their counterparty. It's like a chess game where one player can see all the other players' pieces, but the other player is blindfolded.
Timing is everything in trading. So let's talk about when these consolidations typically show up. Understanding this can save you from walking into a trap. First and most common, after big moves. This is based on a fundamental market principle. Big ranges lead to small ranges, and small ranges lead to big ranges. It's like a pendulum. If you see a massive expansion in price, maybe a 200 pip move in Forex or a huge gap up in stocks, expect a consolidation to follow. The market needs to digest that move. Think of it like running a sprint. After you run as fast as you can, you need to catch your breath before you can run hard again. The market works the same way. Transitioning smoothly. Second, before major economic news. This is huge. Smart money doesn't want to be caught with massive positions right before CPI data, FOMC announcements, or NFP releases. They know these events can cause unpredictable volatility, so they'll often create consolidations in the hours or even days leading up to these events. If you check your economic calendar and see high-impact news coming up, be extra cautious about trading any consolidations you see. Third, when price hits higher time frame levels, let's say on the weekly chart, price reaches a major resistance level that's been respected for months. Even if the daily chart looks bullish, you might see a consolidation form as the market decides whether to break through or reverse. Here's the key insight. Consolidations aren't random. They're strategic. And this concept is fractal, meaning it works the same way whether you're looking at a 1-minute chart or a monthly chart. The same principles apply across all time frames. Professional traders use daily and 4-hour charts primarily to identify these consolidation setups, then drop down to lower time frames only when they have a clear bias from the higher time frames.
Not all consolidations are created equal. There are two main types you need to understand, and knowing the difference can mean the difference between profit and loss. First type, continuation consolidations. These are like pit stops in a race. The market has been trending in one direction, hits a temporary pause to refuel, then continues in the same direction. Here's how to spot them. You'll see a strong move up or down, then price starts ranging sideways, but it hasn't hit any major higher time frame resistance or support. The trend is just taking a breath. When price eventually breaks out of this consolidation, it typically continues in the direction of the previous trend. Second type, reversal consolidations. These are more like a U-turn. The market has been trending in one direction, but it's hit a significant higher time frame level, maybe a monthly resistance or a major psychological level. Now it's consolidating as smart money decides to change direction. The key difference is context. In a continuation consolidation, you're in the middle of nowhere on the higher time frames. In a reversal consolidation, you're at an important level that has historical significance. Now here's what's crucial. Both types are dangerous for retail traders, but for different reasons. In continuation consolidations, retail traders often try to fade the trend, thinking it's gone too far. In reversal consolidations, retail traders often try to continue the trend, not realizing the bigger picture has changed. The smart approach? Wait for the consolidation to end. Don't try to predict which type it is. Let the market show you through price action. If you're bullish and price is consolidating, wait for a sweep of the lows followed by a strong move higher.
If you're bearish and price is consolidating, wait for a sweep of the highs, followed by a strong move lower. Patience beats prediction every single time.
Okay, so I want to talk about something that you probably haven't noticed or maybe seen very often, but I'm pretty sure ICT touches on this. And it's the idea of time-based consolidation. So essentially what that is you are highlighting price under certain time windows, and under those certain time windows you will see price consolidating, or it just looks like it's consolidating. So here you can see price looks like it's consolidating here, right? We have 7 p.m. to 1 a.m., right? It looks like price truly is consolidating under this time window. But if we take off the time windows, it doesn't really look like it's consolidating, right? It actually looks like price is on an upward direction. But if we turn it back on again, you can see, oh, okay, so it does look like it's consolidating. Now, being fair here, if I were to just go from here to here, then sure, it looks like it might just be consolidating in that area. But at the end of the day, if we're not using time to find our areas where we have consolidation, then in reality, this is just price moving upward, but with not very strong price action, not very strong momentum towards the upside. So that's just to show you guys that you can have consolidation, whether it's time-based strictly or consolidation by just looking at any place in time or area in price where you see price consolidating, right? So let me turn it back on again. So real quick, here you can see price looks like it's accumulating, sort of, but not too much. But if I were to turn it off, you can actually see price maybe accumulated here, went down, accumulated again here, and then started moving down again. All right, again, let me turn it on. Here you can see price looks like it's been consolidating, but if I turn it off, it's actually going in an upward direction, right? But again, if you were to only use time-based consolidation, then yeah, from here, this time period from 7 p.m. again to 1 a.m., it looks like price truly is consolidating. All right, so just keep that in mind anytime you're looking for consolidation, right? You can either use time-based consolidation, which is a price range under a certain time period from one time period to the other, or you can just use regular normal price consolidation, which does not involve time, but it might be easier to spot for some people, or it might be a little more difficult to spot for some people. But it's up to you guys. See if you can go on the charts, find something like this, practice with it. I'll link this indicator in the description below. So with that being said, let's move on with the video.
Now, we get to the heart of the matter. In professional trading circles, consolidations are often called seek and destroy conditions. And once you understand why, you'll never look at sideways markets the same way again. The name tells you everything you need to know. Seek refers to smart money constantly seeking liquidity. They're hunting for stop losses and breakout orders. Destroy refers to what happens to retail traders who get caught in these conditions. They get destroyed financially and emotionally. Here's the brutal reality. During seek and destroy conditions, both sides of the market get taken out. Long traders get stopped out when price sweeps the lows. Short traders get stopped out when price sweeps the highs. It's like a systematic elimination of retail positions. But here's the thing. This isn't random market movement. This is engineered. Smart money deliberately runs these levels to gather liquidity for their larger positions. They need someone to sell to when they want to buy, and someone to buy from when they want to sell. Think of it like this. If you wanted to buy 1,000 cars, you couldn't just walk into a dealership and expect them to have 1,000 cars ready for you at the same price. You'd have to buy them gradually, maybe even create some urgency to get sellers to come to you at good prices. That's exactly what smart money does in the markets.
The most dangerous part for retail traders is that during these conditions, your normal trading strategies stop working. Support and resistance become meaningless. Breakouts fail. Reversals fail. It's like the market is playing by different rules, because it is. The only winning move during seek and destroy conditions is often not to play at all.
Let's delve into identifying consolidations on your trading charts. Firstly, seek a well-defined range where you can draw two horizontal lines, one connecting the highs, the other connecting the lows. The real key is to use the bodies of the candles for this range, as the wicks merely add noise. They reveal the true buying and selling pressures. Secondly, observe for multiple touches at each level. If the price has touched the high and low just once, it's not yet a consolidation. Aim for at least 2 or 3 tests to confirm genuine equilibrium between buyers and sellers. Thirdly, look for those wicks on both sides. These are crucial. In a genuine consolidation, you'll often find lengthy wicks reaching beyond the range, with the price promptly snapping back within. They're failed breakout attempts, akin to the market testing waters without commitment. Fourth, keep an eye out for indecision candles. These candles open and close at nearly the same price, with extensive wicks on both sides, resembling spinning tops or doji candles. If these frequently appear, you're likely in consolidation territory. Fifth, stay vigilant for failed breakouts. This occurs when the price pierces the high or low, only to swiftly retract into the range. It's a hallmark of seek and destroy scenarios, with smart money on the hunt for stops, yet not poised for an actual breakout. Here's a pro tip. If a breakout appears but lacks vigorous momentum, it's sluggish and choppy instead of swift and assertive, be suspicious. Authentic breakouts are typically explosive. Remember, these patterns remain consistent across timeframes, whether on a 15-minute chart or a daily chart.
Now let's talk about one of the most important concepts in understanding consolidations: equilibrium. This is where price wants to return to, and understanding this can dramatically improve your trading. Equilibrium is simply the middle point of your consolidation range. If your consolidation high is at 100 and your low is at 90, then equilibrium is at 95. Think of it as the center of gravity for price within that range. Here's why this matters. Price has a magnetic attraction to equilibrium. It's like a rubber band that's been stretched. It wants to snap back to the middle. During consolidations, no matter how far price moves toward the highs or lows, it tends to gravitate back toward this middle point. This creates what we call discount and premium zones. When price is below equilibrium, it's trading at a discount, theoretically cheaper. When price is above equilibrium, it's trading at a premium, theoretically more expensive. Smart money uses this concept constantly. They'll buy at discount levels and sell at premium levels within the consolidation. Meanwhile, retail traders often do the opposite. They chase breakouts at premium levels and panic sell at discount levels. Here's a practical application. If you absolutely must trade within a consolidation, which I don't recommend for beginners, you want to buy near the discount levels and sell near the premium levels. But even then, you need to be prepared for the range to break. The equilibrium also acts as a reference point for measuring the strength of any eventual breakout. If price breaks above the high but then falls back below equilibrium, that breakout is probably fake. If price breaks above the high and stays above equilibrium, that breakout might be real. Think of equilibrium as the 50-yard line in football. It's neutral territory. The real action happens when teams move significantly away from that middle ground. This is where things get really interesting and, frankly, a bit disturbing for new traders. Let me pull back the curtain and show you exactly how smart money manipulates price during consolidations. The first thing to understand is that manipulation isn't illegal or unethical, it's just business. Big institutions need to move large amounts of money, and they need to do it efficiently. The manipulation is simply about creating the most favorable conditions for their trades. Here's how it typically works. Let's say smart money wants to go long. They want to buy, but they don't want to buy at current market prices. They want to buy cheaper. So what do? First, they'll engineer a move below the consolidation low. This triggers all the stop losses from retail traders who were long. It also triggers breakout orders from retail traders who think the market is breaking down. Suddenly, there's a flood of selling. But here's the key. Smart money isn't participating in this selling. They're waiting. Once price drops and all these stops are triggered, creating a bunch of selling pressure, smart money steps in and buys at these lower prices. They're using retail traders' fear as their opportunity. Then they'll aggressively push price back up, often all the way to the other side of the consolidation. This traps the retail traders who sold the breakdown. Now they're underwater on their short positions. The whole sequence might happen in minutes or hours. It's fast, it's efficient, and it's devastating for retail traders who don't understand what's happening. We call this AMD: accumulation, manipulation, distribution. Accumulation is the consolidation phase. Manipulation is the false move to gather liquidity. Distribution is the real move in the intended direction. The manipulation can happen on either side. If smart money wants to sell, they'll engineer a false breakout to the upside to trap retail buyers, then dump their positions. The key insight is this. During consolidations, any sudden, sharp move in either direction should be viewed with suspicion until proven otherwise.
All right, so now that you truly grasp what's happening during consolidations, let's delve into the correct approach. I'm going to be quite honest with you. For most retail traders, the best strategy is simply to steer clear altogether. But if you're determined to trade them, here's the savvy approach from the smart money perspective. Firstly, ensure you have a higher timeframe bias. Never enter a consolidation trade without knowing the cues from the daily and 4-hour charts. If the daily chart indicates bullishness, any movement below the consolidation low is quite likely a manipulation to lure the unsuspecting before the genuine rally. Likewise, if the daily chart leans bearish, a move above the consolidation high could be a strategic move upwards to deceive before the downward trend continues. Secondly, wait for the liquidity sweep. Don't attempt to capture the breakout. Instead, wait for the false breakout. Allow the smart money to run those stops, then position yourself for the authentic move. This approach requires patience, but mark my words, it's how the pros play the game. Third, seek out the AMD pattern: accumulation, manipulation, distribution. The consolidation signifies accumulation. The false break represents manipulation. The distribution is indeed the true move. Your aim is to enter during the manipulation phase, all set for the distribution. Fourth, exercise proper stop placement. Avoid placing stops at evident points, like just above the high or below the low, as these spots are prime targets for manipulation. Instead, position your stops beyond these manipulation zones. Fifth, manage your risk meticulously. Consolidations present inherently low probability scenarios. Employ smaller position sizes. Accept that your stops may be hit more often than not.
The real key is being ideally positioned for that significant move when it inevitably arrives. Remember, the best traders earn their keep on those major moves that follow consolidations, not on the erratic motions typical during such periods.
Alright guys, so I'm going to show you how you can actually trade consolidation, but you can use chart patterns. So you'll notice chart patterns appear more often than not during times of consolidation, and I usually mark them up on higher time frames. So in this case, just to make it super easy and simple for us, I marked up this ascending triangle pattern, and we are going to simply trade liquidity sweeps, right? So obviously this is all hindsight, of course, but if you take a look at this real quick, we are obviously going to trade inside this range here, and we're just going to wait for a sweep of liquidity that is near the edge of this chart pattern here. And then what we're going to want is to see some kind of reversal signal. It can be whatever you guys want, but we're going to keep it very simple. So we're just going to say, okay, we want a inversion of this fair value gap here. We get that inversion here, and we're going to go short, right? And then you can put your stop loss either at the top of this high right here or at the top of this fair value gap. And then you can go for a 1 to 2 or whatever area you feel comfortable targeting. It can be an order block that you're targeting. It can be another area of liquidity. It can be literally anything that you want, right? But you got to be very careful because you don't want to target too far out. Sometimes those areas don't get hit until after, or sometimes they don't get hit at all. And it also depends on the type of chart pattern that you're seeing. And in this case, when we're talking about ascending triangles, you want to be very careful shorting during those ascending triangles. Why? Because price is looking to respect areas of or points of interest from the bottom, right? Or the areas of that are in premium or discount, sorry, areas that are in discount is usually respected a little bit more than areas that are in premium. So as you can see here, price is obviously sweeping highs more than it is sweeping lows, right? So let me remove this real quick. So here you can see price is constantly taking out these highs right here, taking out more highs here, right? And then these areas in the bottom, they're actually being respected a lot more, right? There, over here, right here, or this one, this candle right here, right? And then if I were to mark another one up here, this area right here, right? We're moving up, but we're still consolidating, but the points of interest under the 50% or under the equilibrium are being respected, right? So yeah, that's another thing you guys have to keep in mind. So it would obviously be a little bit better if you were to target buys more than anything, especially if you can find buying options under the equilibrium. So if you can find an area where you can get in that's under the 50%, that would be even better. So in this case, we have it right here. We have a sweep here. We have this change in state of delivery up here, right? That's the change in state of delivery. Stop loss under this area right here. Now we can look to target either that high, because again we're in ascending triangle, or we could just target this long-term high here. It's up to you guys, but it would take a while, obviously, since we are trading in the daily time frame. But that's the thing, guys. You got to be very, very, very careful when trading in consolidation. The best thing that you can do is just to simply stay away from it. Now, I will be showing you another example on how you can trade this. As a matter of fact, I'm going to show it to you right now, just so we don't have to do all this other skipping. So let's just say we mark this up again, right? And then I'm going to show you how you can scale down on that lower time frame. So we obviously know that these order blocks are being respected, right? So what I'm going to do is go back here. Okay, Now we're still going to look for a sweep of liquidity from the bottom, or the area that's under the equilibrium, or the 50% of the fib, right? We're gonna wait for some kind of sweep so that way we can go and target something in the higher time frame. So we know that we want to look for buys more than anything, because again, we're under the equilibrium and we have an ascending triangle. So we drop down to the 15-minute time frame. We can see price respected. It did not go past this area to take out that liquidity, right? Because if we go back again on the daily, you can see that this point of interest was respected, right? So actually, after you saw this bullish candle here on the daily, you could have scaled down to the lower time frame and entered there, or you could have waited for something on the lower time frame to enter and go up to the upside. So you could have either gone down, waited for earlier confirmation, which would have been right here, right? And then you could have entered there, stop loss under here, targeted the equilibrium or slightly above, or even the edge. Or again, you could have waited for that daily time frame candle to close bullish or reject from it. And as you can see here, it also swept this previous daily candle, and price, this bullish candle did not close below it, closed bullish. Again, you could drop down to the 15-minute time frame, and again, this is all time and price from that daily bullish candle. So now we're gonna wait for a entry or a re-entry. Great, so we have that change in state of delivery here again, right here, or that breakout. They also work. Stop loss under here because price reacted from this fair value gap here, right? So you can target this area of liquidity here, or you can target a fair value gap, or you can target this other area of liquidity right here. So we're just gonna let price play out. Perfect. TP, right? Very easy stuff, guys. Very simple. So again, you could have either waited for that sweep and find earlier confirmation for that change in trend on that 15-minute time frame, or you could have waited for that daily candle to finish forming and give us that bullish close on that higher time frame, on that daily time frame, and then drop down to the 15-minute, find an area of entry, which we had right here, right? Price reacted favorably to this bullish fair value gap, saw that change in state of delivery right here, entered after that close of this candle, stop loss under here, then targeted this area of liquidity here. Real simple, guys. Real simple stuff. I will be showing you a few more examples from other content creators so that way you can see how they also trade. And I think you guys might actually like it because it might be a little more simpler than the way I'm explaining it. But again, you can always ask me questions. All right, so let's move on. All right, I said screw it. If you guys want, you can look at the description and link the video to a TT Trades video that he made that I think you guys will truly benefit from watching as well, because he also uses a form of consolidation to find setups, and I think it was really freaking good. So I'll just link that down there, and I want to show you this example in particular. So when you have consolidation, guys, you don't need to have this really wide range of candles or just a really long range in general to find consolidation. It does not have to be like that, okay? You can find a little bit of a range, and that is more than enough. And what you can do is you can actually trade a breakout strategy. So you can find price breaking out around a kill zone. So in this example we have here the New York kill zone. Now this isn't technically an actual kill zone per se, but from my experience and from all the content that I've made, everything that I've studied from ICT, just everything in general that I have seen, people will trade from 6 in the morning all the way till 4:45 or 5 p.m. Someone somewhere has a strategy revolved with these time frames. Someone will trade from like 6 to 7, someone will trade from 7 to 8, someone will trade from 3 to 5. You know what I'm saying? So that's why I use this is why I call it the New York X kill zone, because you can find setups from 6 a.m. all the way to 5 p.m. So here you can see I have marked up this tiny little consolidation, and as we all know, GBP JPY is a asset that loves to consolidate a lot. So we have a breakout towards the upside. All right, and I'm only using the 15-minute time frame. I'm not going anywhere else, just the 15-minute time frame for my bias and for my trade setup. We mark up this consolidation. Price breaks towards the upside out of this consolidation. We also are trading above the 8 a.m. open, which is perfect. And everything's lining up with my kill zones. So I will go long at the breakout here. Now you can either put your stop loss under the breakout, or you can put your stop loss at the middle of that zone. It's up to you. If you want to be safe, you can put it down, or if you want to take a little bit of a risk, you can put it in the middle, but that also means that you can reduce your take profit. So you can go for like a 1 to 2, a 1 to 5, or a strict 2R, or you can target other areas of liquidity over here, but I would recommend to just keep it as short as possible, considering this is GJ. So I'm just gonna go for a 1 to 5 and bang, right? Real easy, real simple. Let's see if we can find another one. Sound like DJ Khaled. Another one. Okay, same thing here, right? So we actually found a little bit of a consolidation here from, and this is up to you guys. You can either mark them from wick to wick or body to body. And I think there's also wick to body. There's a video on ICT talking about this as well. There's so many ways to mark it up, but in this case, we're just gonna mark it up like this, right? So this is a bit of a range, yes, but it's okay. Now, price is clearly bearish. We have London being bearish, all right, and then we have price consolidating towards the downside. Why? Because we see points of interest up here being respected. In this case, this fair value gap here. Price has not broken through it, just swept some liquidity. But what do we have? We have small little breaks towards the downside here as well. And then what does price do? It's going back up, respects this fair value gap, and then keeps going down. So we see price finally break out here. It's under my 8 a.m. As you can see, 8 a.m. right? 8 a.m. open. Price is breaking down. We're gonna enter short. And again, I'm only gonna go 50. No, not 50. We're gonna go over here. Well, yeah, because if I was, let's just say I did go 50%, right? Let's just say I did get 50% and I get stopped out. Well, since I know we're bearish, I'm just gonna look for another re-entry, but this time it's not necessarily gonna be out of consolidation because we already broke out of consolidation here. I can look for another entry at another point in time, whether I'm trading Asia session or a different session, but let's just say I wanted to trade Asia session. Well, I could enter here, stop loss on the high that swept my stop loss, and then again we're going for like either a 1.2R or a 1.5. It's up to you guys, right? But we could have still re-entered during the Asia session because we know that our bias for the day was bearish, and then Asia session starts the new bias or the new consolidation for price to either retrace or expand, right? So let me give you one more example. Obviously this is all hindsight, so it's, you know, take this with a grain of salt, guys. Okay, so this is actually a pretty interesting one, and I am glad I've stumbled upon this. So what do we have here? London consolidates a little bit, so we have accumulation. What do we have here? Manipulation, guys. This area manipulated London, and then what did we do? We started expanding towards the upside. So you guys could have entered, let me see, we could have entered right here, because we had exchange instead of delivery here. Now this is just like another form of like another type of strategy, like a different sort of breakout strategy that I am making up as I'm going here. And then you could have again targeted a 1.2 or a strict 1.5, or you could have targeted like an area of liquidity over here, or London's highs as well. It's up to you guys, but this just goes to show you there are so many ways that you can trade. But the one key thing here is do not go so freaking far with your take profits, and if possible, try to trade in terms of equilibrium, right? Try to find areas where you can buy in areas of discount, areas that you can sell from areas of premium, whether it's using your higher time frame in conjunction with the lower time frame. It's up to you guys. But again, I will also link that video in the description below, and if I find any other videos, you'll probably find some more down there. But yeah, this is just real quick an example of how you guys can find setups with consolidation. But again, I would much rather you guys just did not trade consolidation. And if you're wondering any other methods that you can use other than ICT to trade in consolidation, you can check out my Elliott Wave series. That's also really good with trading in consolidation. Solo, I think it's Solo ETB. He's the one that is probably the best trader that I have seen to trade in consolidation with Elliott Wave and Wyckoff. I'll link his channel down in the description as well. And there's also, like I mentioned earlier, Wyckoff as well. Wyckoff on its own. It's also pretty good for trading in consolidation. But guys, no matter what trading style you choose to go for, it is always recommended by anyone to just not trade during these time periods. All right, and if you're having trouble just figuring out consolidation in general, right, even after watching everything in this presentation, if you want to keep it extremely simple, just look for fair value gaps that aren't being respected, whether it's on the lower time frame or especially on your higher time frames like the 4-hour and up. All right, if you're finding that those fair value gaps aren't being respected, or your order blocks, but specifically more fair value gaps, then that it means that it's more likely than not that consolidation is probably forming. Okay, so just keep that in mind, and again, rewatch the video if you have to, take notes, find some example on the charts, and get to studying. All right, so let's move on. Okay, so I actually found another example, so I wanted to actually show you this again. So again, we have another chart pattern here, and this is on the 4-hour time frame, and we have a descending triangle. So as you can see, it's going down. Price is somewhat sweeping liquidity here, right? That's why I have it marked up sort of going up a little bit, but as you can see, price kept going down. And we're going to also mark this area right here, this order block. All right, so we have that sweep, but price still goes down. It's still going down, as we can see by this line here, and we can see by all the breaks of structure towards the downside. But let's take into account the overall trend, because this is more like type 2 structure. If you don't know what I mean by type 1 and type 2 structure, I have an advanced market structure video that you guys can check out. But to make it extremely simple, type 2 is the more smaller structure, and then type 1 is the overall structure that is essentially price itself. It's everything, right? The big market structure, whether it's on the higher time frame or on that same time frame, but it's just the bigger overall major structure. And what do we have here? Major structure is saying we're going up, right? We have these highs, lows, highs, lows. Let me see if I can paint it up for you. So here, right, we're going up. Beautiful. So we're just gonna go back here. So real quick, what can you see? Price came back at some point, swept some liquidity, tapped into that order block right here, that order block that swept that previous high that started that trend line. Then what did price do? Went down. After it went down, tapped into this order block here, but it respected it. It only mohawked it, kind of like how ICT says, right? It sweeps it up a little bit, but does not break through it. And we're on the 4-hour time frame here, guys. So it's very important. This is 4 hours worth of candle data. Does not break through it and ends up going back up, right? Now, you guys could have still traded during this consolidation. I probably would have waited until price kept forming a little bit more. So like around this, like halfway here, like after this, I see enough data right here, I would have started trading. So I'm gonna go hit the replay button here. Okay, so now I would have known, okay, we have a descending triangle, meaning that I should probably look for shorts, right? So since we don't really have fair value gaps being created either, which is another sign of consolidation if you don't have any fair value gaps, I'm gonna wait for price to, and we're going to use a recent range to go at equilibrium or above it, because in this case we want to look for shorts, right? Because we have a descending triangle, so we want to look for shorts. So I'm waiting for price to be at equilibrium or slightly above it on that higher time frame. Here, as you can see, we are at equilibrium here, and then we're going slightly above it again. So I can actually still look for trades on that 15-minute time frame. So on the 15-minute time frame, I want to see some sweeps. I want to see something that says I'm going to sweep and take some orders to go down. So you can either mark them up, or you could just look at the chart and see what is being swept. So we're going to let price continue. Okay, price is going up. Price is sweeping. So price is sweeping all these highs, right? Swept this high right here. Swept this high right here. All right, now and those are some major swing points, guys. So now I just need something that says we're going down. In this case, we can either look for changes in state of delivery or some big bearish candles. We saw this big bearish candle. I want one more, and as you can see, we have that here. So we can enter short here, and you can either leave your stop loss at this 15-minute high, or if you want, you can leave it right here as well. But for now, we'll do this here. And again, I'm not going to go and target anything crazy, because at the end of the day, we are trading consolidation. Or you can also do what Solo does, which is he enters two positions. You go a 1-to-1 here, and then on that second position, same place, right? Same place here, same place here. But he'll use Fibonacci levels to target, or target areas of liquidity. It's up to what he wants to do. But we essentially have this, right? So with the price play out, TP1, he takes out half of the order, or he takes out a certain amount to whatever he wants. And then he either moves his stop loss to break even after the first TP is hit, or he leaves it the way it is. Okay, perfect. So here I actually want to show you this. Notice how quickly it stopped me out. It swept me to take out this small high here, but price started reversing quickly. Now I could actually still enter a entry here. Now you might say, well, why would I want to do that? Because it looks like price is just consolidating and might keep going up. Notice how quick the rejection of this candle was here. Let me move this out of the way. Notice how quick that rejection was after it swept liquidity. And notice how quickly price started displacing here, right? We had that sweep from here, started going down, more bearish candles, right? And look how it inverted this fair value gap here, right? Now, obviously the displacement wasn't strong, but we still have that inverted fair value gap there. So I'm going to re-enter there again. And I can either target that 4-hour set of liquidity here, or just that liquidity here just to be safe, which is what I want to do. So it's that area right here, that low right here. The price continue, bam, TP, right? Perfect. So that is another reason why I would have re-entered. I'm not just going to re-enter just because I'm upset that I got swept here, right? That would be foolish. See that small sweep? That would be foolish. I'm not going to just revenge trade. I'm not just going to enter. I have to find a reason to enter, right? The reason was strong wick rejection, and then price started displacing under this fair value gap, right? So I entered once price inverted that fair value gap. You can't just re-enter just to re-enter, guys. Okay, you have to find good reasons to re-enter. Okay, so with that being said, I think we should be good. Let's move on to the end of the video. And obviously, guys, there's so many ways to trade, so many ways to trade in consolidation again. But please, if I was you, I'd stay away with consolidation. All right, just stay away from it.
Now let's talk about the common mistakes that get retail traders in trouble during consolidations. If you can avoid these traps, you'll be ahead of 90% of traders. First mistake, trading within the range. This is the biggest trap. Retail traders see a consolidation and think, easy money, I'll just buy the bottom and sell the top. But here's the problem. You never know when the range is going to break, and when it does break, it often happens fast and violently. Second mistake, chasing breakouts without confirmation. Price breaks above the high, retail traders think, here we go, and they buy. But then it's a false breakout and price crashes back down. Always wait for confirmation, either a retest that holds or a strong impulsive move away from the range. Third mistake, using tight stops. Because consolidations are choppy, retail traders often use tight stops to limit risk. But this actually increases risk because you'll get stopped out by normal market noise. Give your trades room to breathe. Fourth mistake, over trading. Consolidations create a lot of what looks like trading opportunities, but most of them are traps. The more you trade during consolidation, the more likely you are to lose money. Quality over quantity. Fifth mistake, ignoring the higher time frames. Maybe the 15-minute chart shows a nice consolidation breakout, but the daily chart is at major resistance. The higher time frame will usually win. Sixth mistake, trading during low volatility periods. If you're seeing very small ranges, lots of indecision candles, and minimal price movement, just walk away. These are the worst conditions for retail traders. Seventh mistake, not recognizing seek and destroy conditions. If you see equal highs and equal lows, if PD arrays aren't following through, if you're seeing a lot of false signals, these are warning signs to stay out. Remember, not trading is a position. Sometimes the best trade is no trade.
Time frame analysis is absolutely crucial for understanding consolidations. Most retail traders make the mistake of focusing on just one time frame, but consolidations need to be analyzed from multiple perspectives. The foundation is always higher time frames. Start with the daily chart, then the 4-hour chart. These are your big picture charts. They tell you the overall market structure and bias. Is the market in an uptrend, downtrend, or sideways? Where are the major support and resistance levels? What's the institutional order flow suggesting? Here's a key principle. The lower timeframes are subordinate to the higher timeframes. This means that if the daily chart is bearish, any consolidation you see on the 1-hour chart should be viewed through a bearish lens. Even if the 1-hour consolidation breaks to the upside, if the daily is bearish, that breakout is probably a trap. The daily and 4-hour charts are where you identify your directional bias. They're where you spot the major consolidations that are worth paying attention to. Lower timeframe consolidations that aren't visible on the daily or 4-hour are usually just noise. Once you have your higher timeframe bias, then you can drop down to lower timeframes for entry timing, but never lose sight of the bigger picture. The 15-minute chart might show a perfect breakout setup, but if it goes against the daily trend, it's probably going to fail. Here's the fractal nature of consolidations. The same patterns that work on the daily chart work on the 1-minute chart. The same manipulation tactics, the same AMD patterns, the same false breakouts. The only difference is the time scale. Professional traders typically use this hierarchy.
weekly for the long-term trend, daily for the medium-term bias, 4-hour for the short-term structure, and 1 hour or 15-minute for entries and exits. Remember, consolidations are more reliable and worth trading when they're visible on higher time frames. The bigger the time frame, the more significant the eventual breakout will be.
Knowing how to exit consolidation trades is just as important as knowing how to enter them. This is where many traders give back their profits or turn small losses into big ones. First, let's talk about exiting when you're right. Let's say you correctly identified a consolidation, waited for the manipulation, and positioned yourself for the real breakout. Now what? Target the external range first. If the consolidation was between 100 and 110, and you're long from a manipulation below 100, your first target should be above 110. This is the minimum expectation for a true breakout. But don't put all your eggs in one basket. Take partial profits at the first target. Maybe close half your position when price breaks above the consolidation high. This locks in some profit and reduces your risk. For the remaining position, you can trail your stop or look for higher targets. Often, the initial breakout from a consolidation is just the beginning of a larger move. But be prepared to exit if you see signs of weakness. Now, what if you're wrong? What if what you thought was a manipulation turns out to be a real breakout in the opposite direction? This is where proper stop placement is crucial. Your stop should be beyond where the manipulation should reasonably go. If you're long and expecting upside, your stop should be well below the consolidation low, not just barely below it. Accept that false signals happen. The key is to keep your losses small and your winners big. It's better to be stopped out of a few false setups than to hold onto a losing position hoping it will turn around. Here's a pro tip. If price returns to equilibrium after a breakout, be very suspicious. True breakouts tend to stay away from the consolidation range. If price keeps getting pulled back to the middle, the breakout is probably fake. Also, watch for volume or momentum. True breakouts typically have strong momentum. If the breakout is slow and choppy, it might be another manipulation.
Risk management during consolidations is absolutely critical because these are inherently dangerous trading conditions. Let me give you a comprehensive framework for protecting yourself. First, recognize the warning signs of low probability conditions. If you see equal highs and equal lows that haven't been swept yet, be cautious. If you see PD arrays, things like order blocks and fair value gaps, aren't following through like they normally do, that's a red flag. If you see non-symmetrical markets where correlated assets are moving in opposite directions, stay out. Second, understand seasonal and news-related risks. Avoid trading consolidations right before major economic news like CPI, FOMC, or NFP. Big money doesn't want to be caught with large positions during these events, so they'll often create choppy, unpredictable conditions leading up to them. Third, after large expansion days, expect consolidation the next session. If you see a huge move one day, be extra cautious the next day. The market often needs to consolidate after big moves, and this creates seek and destroy conditions. Fourth, watch for London session manipulation. If London sweeps both the high and low of the Asian range before New York opens even then, that's often a sign of choppy conditions ahead. It means liquidity has already been grabbed from both sides. Fifth, use appropriate position sizing. During consolidation periods, reduce your position size. These are low probability environments, so even if you're right about the direction, the path might be much choppier than expected. Sixth, don't overtrade. The biggest mistake retail traders make during consolidations is trying to force trades. Every little move looks like an opportunity, but most of them are traps. It's better to wait for one high-quality setup than to take 10 low-quality ones. Seventh, respect your stops. Don't move your stops against yourself just because you think you're right about the bigger picture. The market can stay irrational longer than you can stay solvent. Remember, capital preservation is more important than capital growth. You can't make money if you don't have any money left to trade with.
Now, let's look at some real-world examples to see how all these concepts play out in actual market conditions. These case studies will help you recognize these patterns when they appear on your own charts. Case Study 1, the classic AMD pattern. Here, we see a textbook accumulation, manipulation, distribution setup. The price consolidates in a tight range for several hours, forming equal highs and lows. Then we get the manipulation, a sharp drop below the lows that triggers retail stop losses. But notice how quickly price reverses back up and breaks above the consolidation high. This is smart money using retail fear as their buying opportunity. Case Study 2, the false breakout trap. This is painful to watch if you were on the wrong side. Price breaks above the consolidation high with what looks like strong momentum. Retail traders pile in long, thinking this is the breakout they've been waiting for. But it's a trap. Price reverses aggressively, not only taking out the longs, but also breaking below the consolidation low to grab those stop losses too. Case Study 3, Pre-News Consolidation. Here's a perfect example of how the market behaves before major economic announcements. You can see the tight, choppy price action with multiple false breaks in both directions. Nobody wants to take big positions before the news, so we get this equilibrium trading. After the news, we finally get the real move.
Case Study 4, Higher Timeframe Context. This example shows why you always need to check the bigger picture. After marking up the daily timeframe consolidation pattern, you can drop down to the 4-hour timeframe, and you can also see how some order blocks are respected, depending on the type of consolidation or seek and destroy tactic being used by the bigger players.
The key lesson from all these examples is patience. In every case, the traders who made money were the ones who waited for confirmation, rather than trying to predict the breakout direction.
All right, let's wrap this up with the most important points you need to remember about consolidations. First, and most important, consolidations are not boring sideways markets. They're sophisticated battlegrounds where smart money systematically traps retail traders. Respect them. Second, the best strategy for most retail traders is avoidance. Wait for the consolidation to end before taking positions. Let someone else get chopped up in the range while you wait for the clean breakout. Third, if you must trade consolidations, always have a higher timeframe bias on your side. The daily and 4-hour charts should support your directional assumption. Never trade against the bigger picture. Fourth, understand that manipulation is normal. False breakouts, stop runs, and liquidity grabs are features of consolidations, not bugs. Expect them and plan for them. Fifth, focus on the AMD pattern: accumulation, manipulation, distribution. The money is made on the distribution phase, not during the accumulation or manipulation phases. Sixth, use proper risk management. Smaller position sizes, wider stops, and strict discipline about cutting losses when you're wrong. Seventh, remember that consolidations are fractal. The same principles work on all timeframes, but higher timeframe consolidations are more significant. Finally, be patient. The market rewards patience and punishes impatience. The best opportunities come to those who wait for high probability setups rather than forcing trades in low probability conditions. Master these concepts and you'll avoid the traps that catch most retail traders. More importantly, you'll be positioned to profit from the big moves that inevitably follow consolidation periods. Good luck, trade safe, And remember, sometimes the best trade is no trade at all.
Thanks so much for watching today's video. I really appreciate you taking the time to tune in. If you enjoyed it, make sure to follow me across all platforms so you don't miss future content. Down in the description, you'll find links to the brokers I personally use, some backtesting software I recommend, and of course our free Discord community where you can connect and learn alongside other traders. I'll leave you with one of my favorite verses, Wisdom of Solomon 6:12. Wisdom is radiant and unfading, and she is easily discerned by those who love her and found by those who seek her. And as always, remember, strive for progress, not perfection. I'll see you in the next one.